Right now, public equity markets are hitting all-time highs, yet daily living feels impossibly expensive. The economy is pulling in two completely opposite directions. Pandemic-era savings are gone. Consumers are exhausted, increasingly relying on buy now, pay later financing, not for luxury purchases, but to cover basic utility bills and dental work. To survive the cumulative squeeze of inflation, shoppers are actively trading down to private label store brands, leaving retail spending highly polarized. This structural rewiring, the Great Bifurcation, represents a permanent change where the rules of the stock market and the daily physical economy have effectively stopped overlapping. The U.S. government is running a structural deficit greater than 5% of GDP. This state of fiscal dominance forces the Treasury to maintain higher for longer interest rates just to attract the capital needed to fund that deficit. For debt-reliant industrial companies, elevated borrowing costs act as a trap's bottom jaw. The top jaw is the industrial ceiling, manufacturing capped by aging grids and energy costs. U.S. electricity runs 8 cents per kilowatt hour, while Europe reaches over 20 cents. This physical bottleneck is so severe that deep electrification projects are stalling out, stuck in grid connection queues that now stretch 5 to 10 years. Trapped by this pincer maneuver, traditional industrial expansion is suffocating. Smart capital is now aggressively hunting for a highly specific, resilient type of physical asset to survive. In 2026 alone, the 5 largest technology hyperscalers have committed to spending between $660 and $690 billion on physical infrastructure. They are building 750 megawatt campuses that function as heavy industrial plants, requiring a scale of power and space that redefines the physical footprint of computing. The companies building this infrastructure are generating immediate, compounding revenue. By contrast, the pure-play artificial intelligence software vendors consuming that compute still have relatively tiny revenue bases. The era of low-capital software growth is fading. Hyperscalers like Amazon and Microsoft are now spending down their free cash flow reserves to secure massive physical capital structures. The artificial intelligence revolution has left the purely digital realm. It is now a high-stakes race to own and control physical reality. The core vulnerability of this entire hyperscaler build-out is the absolute requirement for 24/7 uninterrupted baseload power. Natural gas has become a permanent, critical pillar for powering these centers, providing the 24/7 reliability that intermittent sources can't yet match. Tech developers are adopting a bring-your-own-power strategy. They simply cannot afford to wait for utility grid interconnections, so they are actively choosing to build their own on-site generation. As a result, the traditionally slow-moving utility and energy sectors are undergoing a renaissance, transforming into the critical supply chain of the tech boom. Despite this concentrated tech boom, the broader economy faces severe headwinds. Central banks risk a major policy error by holding interest rates high while dealing with an ongoing energy supply shock. Under the surface, the private corporate lending market is showing deep stress, with default rates hitting a high of 6%. Unrated industrial and manufacturing firms are bearing the absolute worst of this. Crushed by the pincer maneuver of debt and energy costs, their default rates are pushing past 10%. The rising tide is highly localized. If caught in the traditional manufacturing sector without access to the tech capital fire hose, you are actively drowning. For the next 12 months, investors must prioritize companies that own critical, load-bearing infrastructure over speculative software growth. Hyperscalers are actively de-risking these power and infrastructure projects by acting as long-term financiers, creating a durable competitive moat around physical grid assets. The global markets are currently repricing the value of the physical world, placing a massive premium on the resources that actually keep the machine running. By understanding this shift from digital hype to physical power constraints, you can find safe harbor and real opportunity in the Great Bifurcation.